My name is Greg Michalowski. I'm the Chief Currency Analyst for FXDD, and this is a special report for SFO. Oftentimes I go to trade shows or seminars and I have people come up to me and say, Greg, listen, I'm interested in trading foreign exchange, but I find that trading foreign exchange is, well, foreign to me. I just don't understand the characteristics of the market, how to trade it. And to this I say there are certain characteristics in the foreign exchange market that are very similar probably to, let's say, trading S&Ps or perhaps trading S&P minis. Those characteristics include large liquidity. There's $4 trillion a day in the foreign exchange market, large number of traders, and transparent pricing. Transparent pricing translates into transparent charts. If everyone's looking at the same chart, they're able to define very same or similar support and resistance levels. Those resistance levels can come against simple technical tools that are visual to the market. Moving average lines, trend lines. These are two technical tools that provide transparency not only in the charts but also transparency in key technical levels. We'll talk about that in just a second. Now if you take a look at the S&P market, they have similar characteristics: large liquidity, large number of trades, and transparent pricing. So if they have transparent pricing too and transparent charts, you would think that there would be characteristics of trading foreign exchange that are bridged over to the S&P market. Let's take a look. Here's a chart of the S&P on a daily basis. I have two moving averages in the chart, two very used moving averages by the market. One is a 100-day simple moving average. The other is a 200-day simple moving average. And what I want to focus on is this point number one. The market's moving to the upside here, and what do? We find resistance against that 100-day simple moving average. The market stalls at that level. Why? Because traders can define risk against that level. If they were to sell against this level, take profit against that level, then if the market should move higher, they'd simply go long, cover their short, just reverse their position that they took at the 100-day moving average. If they're right and the market does indeed roll over like it did in this example, they can benefit from the market moving down and perhaps buy against the dip. Let's take a look at point number two. This is the same dynamic. In this case, the market moves higher, finds resistance against the level, and then when it breaks through the level, it says go long. Get rid of your short position that you had against the 100-day moving average. Go long, and lo and behold, a few days later, the market breaks above the 200-day moving average and moves sharply to the upside. Let's fast forward to this point at point number five. At this point, the market is moving to the downside here, and what do? We find support against the 200-day moving average. Why do we find support against that level? Because risk can be defined. If risk can be defined and everyone sees this visual in the market, they're able to buy against that level. If the price moves below, they stop themselves out, maybe go short. If the market holds that level, they can benefit from the move to the upside. They get a second chance in this chart when the market moves down again and tests the 200-day moving average for the second time. When it holds the level again, we get a bigger move to the upside. Now let's take a look at these trend lines. These trend lines form a nice parallel channel here. I want to focus up here at 3, 4, and 5. We set the trend line 1, 2. At 3, 4, and 5, we hold that trend line. And this gives a bias to the upside. It's a bullish bias. The market will stay bullish until the market moves below the trend line, and that happens at point number 6. When the market breaks below that trend line, we see the momentum develops to the downside. Why? Because risk is defined at this level. Traders can go short on the break as long as the price remains below that trend line. The bias remains to the downside. We find support against the 100-day moving average, and that prompts the market to move back up to the upside. Now let's take a look at the euro versus US dollar and see if it has similar characteristics. And what we see here is I've put in the 100-day moving average and the 200-day moving average, same moving average that I use in the S&P. I want to focus down here at point number 2. The market breaks below the 200-day moving average, and what would you expect? You would expect that after holding support here at 1, the break of the 200-day moving average at this point would lead to lower levels, and indeed it does. But what we see is that the move to the downside isn't long-lived. That is, when momentum fades and the market starts to move higher at this point. On this bar right here, the market moves back above the 200-day moving average, and traders who are short should now get long. Why? Because they can define risk against this level. If they can define risk against the level and for example, and put a stop below the level, they've limited their risk. They've also been following what the market is doing, and if the market is if all the market players are seeing the same thing, it's likely, or perhaps there's a chance that they all buy against the level and the market moves higher like it did in this point. Now let's fast forward to this point at point number 5. Once again, similar to what we saw in the S&P, the market was moving to the downside. And once again, what did we do? We found support against a key technical level, a technical level that is visual, a technical level that the market uses. In this case, it was a 100-day simple moving average for the euro versus US dollar. Market found support against that level. Why? Because risk could be defined. Risk is defined by buying against the level and stopping yourself if the price moves below. In this case, the market finds support against the level and moves back to the upside. Now let's take a look at the trend lines and see if we have similarities in the trend lines in the euro versus US dollar. And what we see here is that in this case, we have a well-defined channel here. The number of times the market tests above and below the top side and the downside of this channel, very clean channel until this point right here where the market breaks above. The market increases the momentum to the upside, is accelerating the momentum to the upside, and this is bullish for the euro versus US dollar. Bullish as long as the price remains above that trend line. 1.7, the market moves back within the channel and breaks through this trend line. The market's saying this move to the upside is a failed move. It's time to get short. Why? You can define risk against this level. Risk is limited, and if the market should move higher, you simply get long. But if the market should move lower, you have the benefit of this move to the downside. And 2 days later, the market not only has moved down testing the lower trend line, it's also breaking through that trend line, and that trend doesn't stop until the market reaches the 100-day moving average way down here. So as you can see, there are there's similarities between the S&P and the euro versus US dollar. Both of them are very liquid markets. Both of them have a lot of traders. Both of them have transparent pricing and transparent charts. If you have transparent charts, it's likely that you can define certain visual technical levels by using simple tools like trend lines and moving average lines. Don't be surprised that you'll find that the foreign exchange market is not as foreign as you think. My name is Greg Mikulowski for SFO and FXDD.